Good morning, everyone. My name is Wendong Zhang. I'm an assistant professor of economics and extension economist at Iowa State University. I'm really happy that you tuned in today through our YouTube live stream today. I'm happy to announce the results for the 2020 ISU Land Value Survey. During this unprecedented year, I hope you and your family stayed safe and healthy. So a little background about myself before going to the survey. I grew up in China, went to college in Shanghai, and got my PhD from Ohio State in 2015, and then worked 1 month after getting my PhD started at ISU in August 2015. A lot of my responsibility involves this survey that has long history and a lot of legacy that started in 1941. So I was chatting with my predecessor and some of our support staff that many of you, when my predecessor started in early 1980s, working through his 30-some year career, I wasn't born yet. But I'm really happy to take on this long, important tradition. And a lot of the new changes I'm doing is not only I'm announcing this year's results, but you can find the land value survey results at this card.istate.edu/farmland ISU farmland portal that you can find land value information since 1950 for your county, not only the survey that I conducted. So in addition, I have taken on we're about to release the results for 2019 Iowa Lakes Survey that looks at Iowa public and neighboring states' general public visitations to Iowa lakes. This is funded by Iowa DNR. And I'm also doing a lot of work with Dr. Dermot Hayes in the ISU China Center related to the Phase 1 deal, African swine fever, among other things. I also want to make one announcement that one of the new change during this COVID-19 era is that as ISU Farm Managed team announced the virtual free seminar every month on a Thursday called the Ag Decision Maker webinar, that this Thursday I will be doing the December webinar, which I will be talking about this land value survey results if you missed it today. And I will also talk about a new survey that I've done with Mr. Dave Baker at ISU Beginning Farmer Center, which it's an updated survey looking into how Iowa farmers make farm succession and retirement transfer plans. Have they identified successors? Who are their successors? If they retire, what they miss from the farming and things along those lines. Okay. So, and you can find the registration link here. So it's free, but you need to register to receive the link to watch it. You can also find on the Ag Decision Maker website. So, okay, without further ado, I want to, so one more slide about myself. So I grew up in China. This is the Chinese map overlaying with the lower 48 states with the stars, not the capital of China. Is my hometown. On the right is showing you the production scene in my hometown area with my uncle holding his grandson in the vegetable greenhouses, which if you look at the latitude is roughly the same latitude with Kansas. So it's dramatic transformation of the Chinese agricultural production scene from 1,000 years of corn and wheat production to now to table grapes before this, and then to vegetable production. And now, when you're looking at my hometown counties, which is the rural county with 1 million people, so you can understand the scale of the Chinese demand, and also you can understand that the dramatic transformation in these crop production shifts only occurred in the last 30 years. So 30 years ago, everyone is growing corn and wheat, and then switched to table grapes, and now everyone is growing vegetables for exports and larger cities. So in contrast, we're seeing more stability in the production scene in the Midwest, in part because that we are really good in terms of the soil quality, precipitation. So in a lot of my hometown area, for example, relies a lot more on irrigation, and it's a much smaller farm size compared to what we have here. That also explains why we are seeing a whole lot of demand from China for agricultural products that drives the farm income and land values. So one of the things I want to mention is for the land value survey, it's an expert opinion survey. So, which means that this is a survey that every November we send out the surveys to farm managers, brokers, appraisers, and assessors who are knowledgeable about the land market. Then, so we follow the same questionnaire that is used in decades. However, this is not necessarily a statistically representative survey. This is just the opinion from the agricultural professionals who are knowledgeable about the land market. Its intention is to give you a sense of the trends in the land market. Is not necessarily saying that this particular parcel in Story County will and should be selling for this particular price, right? So, however, another thing is when you are comparing results like this with other surveys, this is true not only for our survey but for others as well, the percentage change estimates will be more salient than the dollar amounts, okay? So what the survey this year looked like, we essentially, despite the pandemic, we got tremendous help from the professionals. We got responses from 784 agricultural professionals providing land value estimates for 707 counties. So which means that some respondents, some professionals provided estimates for more than one counties. And when you're looking at who they are, the bulk of the largest category is 38% are ag lenders, and followed by a broker and realtor, farm manager, appraiser, and the government people includes both county assessors as well as the USDA Farm Service Agency officers. Okay, so when you are looking at across the districts, this coincides with the number of production acres and number of farmers in the states as well. In southern part of the states, we always have more struggles. And if you are knowledgeable about especially Southern Iowa land market, but it's not part of the land value survey already, please feel free to get in touch with me. And we also often lack responses in highly urban towns like Polk County and Scott County. So what are the, so when we are looking at who the respondents are, they tend to have really long experience. And on average, the ag professionals have 27 years of experience and serving about 7-8 counties in general, with exceptions that the county assessors often only serve one county, right? So we have a incredibly knowledgeable respondents, which we also seen this year. Interestingly, there are we have more retirements, it seems, that for our previous respondents. So what is the key number? The number everyone is looking for is, as of November 1st, 2020, the Iowa farmland value, the average value of Iowa farmland stands at $7,559 per acre. This is not just the average cropland prices, this is the average farm real estate prices, and also includes potentially non-cropland types with timber and pasture, right? So this is average farmland values for Iowa as of November 1st, 2020, compared to a year ago. This represents about 1.7% growth, or 127% dollar increase. So when we are looking at the high quality land it stands roughly constant. It's actually down $10, down 0.1%. The medium quality is up 2.6%, and the low quality have shown the largest increase, 6.7% growth to over $5,000 per acre now as of November 2020. When we are thinking about the long-term perspective, I will break down the determinants and the factors that are driving the differential trends for different land qualities. But overall, when we are looking at, for example, this 1.7% growth, how do you make sense of it? Overall, when you are thinking about this land market, this still represents about 13% off compared to the 2013 peak, and about 22% drop compared to the if you use inflation-adjusted numbers. However, when you are thinking about this 1.7% modest growth, it does represent the third rise over the past 6 years and the second consecutive rise followed by last year's growth. So these numbers, these percent growths are still fairly modest. So overall, you are typically seeing inflation would be around 2%. So this is still in that range. So this when you are thinking about the inflation-adjusted values, is still not representing an increase. However, it does represent a surprisingly resilient and strong and robust land market, considering the significant uncertainty that is posed by the COVID-19 pandemic especially. So what are some of the key factors that is driving up the land market? The highest percent of the factor that is mentioned by most agricultural professionals is a favorable interest rate, meaning that much lower interest rates near zero levels cut by as a result of the drastic cuts by the Federal Reserve this March have typically pushed up the land markets. So in general, I've talked about this before, land values roughly equals income divided by interest rate. When you have lower interest rate, you have easier financing, and also there's also meaning that the interest rate is also a yardstick for what you can get from the bond and so alternative investment. So when those returns are low, that tends to push the investors more like the farmland, the higher demand. Right. So another factor that is denoted as the last two bars in this chart is represented by really strong and record level government payments. So mainly in the form of COVID-19 reliefs, in the form of CFAP and CFAP2 payments, so coronavirus food assistance programs. So when you are thinking about how significant things are, the right figure shows you the government payments charts since 2015. So when you are seeing that in 2015 and 2017, the regular program roughly provided $10 billion government payments injection into the farm income, right? So this includes the programs, the our county and PLC and things like those. What is interesting, what is new is 2018, there's starting in 2018, 2019, and even in February 2020, there's MFP payments, of market facilitation program payments, trade aid payments designed to mitigate and compensate the impacts coming from the trade war with China. So that the third tranche of the 2019 payments showed up in wasn't paid out until February 2020. So that shows up in the 2020 number, and the the brown bar, which essentially represents the significant increase in the COVID relief in the form of CFAP and PPP and other government payments. And this also includes, for example, in Iowa, the payments to deal with the ratio in August as well. But overall, we are seeing a record amount of government payments standing at $46 billion, and which drives a much higher farm income, the highest level since 2013. So on the left, this figure shows you the net cash farm income and net farm income. The net farm income is at almost $120 billion. So this is a drastic increase, almost a 40% increase compared to last year, largely driven by the injection of those government payments, right? So this increase is about $35 billion, and the government payments stand at 46, right? So when you are thinking about the economic fundamentals of the agricultural economy, it's not as rosy as the left figures suggest. However, so the fundamentals is not necessarily, so the trajectory, upward trajectory showing this year is not the same as what we are seeing from 2006 to 2013 with the rising commodity prices driven by rising demand from China, ethanol, and things like those. So this is more of an artifact of the government payments. However, this does provide the necessary stability in the farm income, as well as this also got reflected in the land market as well. So some other factor that mentioned in previous years that we are still in a land market was fairly limited land supplies. So this year is a little better. I will show you that slightly more people noting more sales actually compared to a year ago. But note that we have been in a situation that year after year for 5-6 years, every year there's less sales compared to a year ago. So even if we are seeing some modest growth compared to last year's, we're still in a fairly tight market, which tends to increase the competition and demand for land as well. And another factor that is interesting is that we conducted this survey in November, and I will show you some of the comparison with the other surveys, and we are seeing some more optimistic and stronger results compared to other surveys. For example, one of the other more recent reasons is that we have seen tremendous unconventional commodity price rallies post-harvest that mainly driven by the surging exports to China, and also there are some concerns about the production and weather conditions in South America. So what we are seeing is that we have seen tremendous rallies, post-harvest commodity price rallies for both corn and soybean, especially soybeans. That when you are looking at the pattern, this is this two charts. On the left is soybeans, on the right is corn. And this shows you the whole year, so January to December. In general, when you are seeing the price rallies, that tends to occur pre-planting. So it's April to early July, late June is the time that when you are uncertain about whether the planting will go smoothly, whether there will be weather concerns, so that will tends to cause a price rally. And when you have a bountiful crop harvest, as we do this year, you tend to have dampening prices post-harvest, right? So, however, this year is unconventional in many regards. That first, that when we enter April, in the season, in the regular season, we're supposed to have some pre-harvest, pre-season planting rallies, the spring rallies. We were hit hard with the COVID-19 pandemic with significant uncertainty and dramatic decline in the demand for agricultural products, especially the livestock products and ethanol, right? So that drive down the corn prices and as well as the soybean prices significantly. And when you're looking at a lot of those rising commodity prices, those are mainly driven by rising, especially ramping up pace in exports to China. So this is one of the charts that we created that tracks the monthly exports to China from all the U.S. agricultural exports. In October, we actually posted record level exports to China ever, right? So this is the highest amount of the sales ever. So this translated into the surge and strong sentiments in the commodity market, and that's shown in the red line in this chart. The other line you should pay attention to is the 2017 line, which is a grain charts, grain line, which represents the baseline for the phase one deal. So the phase one trade deal that is in place, essentially China pledges to buy $12.5 billion more compared to 2017. And when you are thinking about how China is doing, they're still below the target, but the pace is growing significantly. And we are about to see the highest agricultural exports to China ever, right? So the typical range of the exports annually to China stands at about $20 to $25 billion, and we're about to see probably at least over $30 billion this year. However, when you are thinking about the lofty target prescribed in a phase one, that is denoted as the black dashed line, even the record exports in October is still below the season-adjusted target for October. So there's still uncertainty about what is the political ramifications given the change of administration, and as well as the facts that when USTR potentially do assessment of how China performs in these phase one deal, how we move forward, and whether there will be some actions if we find, for example, China is $2-3 billion short. What will happen? But regardless, I think this phase one deal has led to a dramatic increase in terms of the exports to China, which we are seeing record amounts. And also this a key factor is China still rebuilding the hog herd. They still have pork shortage, which supported a lot of those purchases. Right? So some other factors that I mentioned in terms of interest rate, on the left it shows you the federal funds rate, which is a policy interest rate that manipulated by the Federal Reserve. And you can see that in 2020, to the right end of the chart, it's fallen off the cliff. It's essentially the deliberate cuts, drastic cuts from about 1.4, 1.5% to near zero levels in anticipation of how bad the COVID-19 pandemic could hit the economy, right? So my colleague Chad Hart and I have done some research looking into how long these impacts would be capitalized into the land market. And this on the right shows you sort of the busy figure, but this essentially shows for all the recent interest rate hikes and cuts, what are the effects over the long time. So overall, when you are seeing, for example, the green color, that means the impacts of the 2020 Federal Reserve cuts that we've seen this March, how that will be play out this year and in the following 4 years. Right? So this chart starts from 2016 to 2025. Right? So which means that for the 2018 interest rate hikes, it takes nearly a decade to be fully resolved and capitalized in the land market. And the interest rate cuts that is done in 2019 doesn't reverse the 2015 to 2018 interest rate hikes, but the recent March 2020 cuts fully reverse these impacts. So overall, we will be seeing a positive increase, overall positive effects through all the policy changes in Federal Reserve federal funds rates in general, because when you cut interest rate, remember the formula land values equals income divided by interest rate. When you have dramatic cuts in interest rates, the denominator goes down. So then the land market receives support and tends to drive up land prices. Right? And that effect won't be immediately felt and will take about a decade to be fully resolved, with the peak effects shown in next year's land values. Okay? So another thing I mentioned is that we still have limited land supplies. This year we have 38% of the people saying they are reporting more sales, and about 20% reporting less sales. So slightly more people reporting more amount of the sales compared to a year ago. And however, we're still in a tight land supply because for 5 consecutive years, we have reporting less and less sales compared to a year ago. Right? So one of the other reasons I mentioned earlier is that when you are thinking about the land market, another survey that I have conducted with my colleague Alejandro Plastina and William Swadago, who is now was graduate students and now assistant professor at Auburn University, we find that 82% of Iowa land is debt-free. Right? So when you have a whole lot of land that's fully paid for, you don't have a significant urge for the land to necessarily go on the market. Right? A little more notes on the surging exports. We have seen a dramatic increase in the sales for the 2020 crop. Not only the purchases, but also advanced sales. So this is one of the uncertainty in the policy calculations that I trust that the U.S. Trade Representative, when they are comparing, for example, how high the Chinese exports would be, they would be not only counting the actual purchases, but also the advanced sales, which is the commitments, which may not be necessarily be realized before the end of the year one. Right? However, with the dramatic price rallies that you see here, and which correlates so strongly with the Chinese demand, and we can see that despite the trade war, China remains an indispensable trading partner of the U.S. agriculture, and that is really significant in supporting farm income, commodity markets, and also have positive impacts in capitalization into the farmland market. And my colleague Dermot Hayes and I was working with postdoc Xi He. We have predicted that China is about to import about $31 billion from the U.S. From February this year to February next year. Even if we do, say, the calendar year calculation from January to December 2020, we roughly have this similar total numbers, around $31 billion, with slight adjustment across the distributions. What is interesting is we have such higher numbers compared to previous years. The range is around $20 to $25 billion. However, the growth is not necessarily seeing additional demand from soybeans, right? So soybeans, as I showed earlier, has shown tremendous growth, that we have seen dramatic increase, especially for this year's crop. However, when you are thinking about when China buys this $31 billion, these record level growths are not necessarily coming from soybeans. It's coming from corn that China haven't been bought for such a long and long time in large quantities, and also record exports in pork and beef, largely driven by China still has a pork shortage due to the African swine fever, which they target to return to pre-African swine fever levels next year, right? So I think at least next year we'll still see really strong and robust exports to China. And another good factor for the U.S. is that one of the key competitors we have, Germany, is also battling with African swine fever, right? So that will drive the exports and commodity markets. However, I want to make one of the points here is that this provides another reminder that when we are thinking about U.S.-China agricultural trade, and we should not only just think about soybean, we should also think about what other portfolios that we can sell to China to have a more balanced portfolio to achieve higher total, and that will also be viewed as more favorable to China as well, because they can build more economic and ties with more agricultural states beyond the Midwest as well. Another thing that is apparent is that with 20% of the agricultural products, U.S. agricultural products, going on a global market, the performance in the export market is really significant for commodity prices as well as for farm income, which also will be capitalized in the land market, right? So, one more thing about the positive factors is that this year, due to the commodity prices, due to the COVID-19 pandemic, we have seen tremendous volatilities and uncertainty in other investments, such as the stock market. So on the left, this shows stock market volatility. It's not the stock market index. It shows you how much fluctuation and uncertainty these markets are showing. This shows you these volatility index since 2016. Right? Okay, and you can see that to the right of the chart that the 2020 is really a different year. Right? So with the COVID-19 pandemic, that has really shot up the stock market uncertainties, and which, when you are thinking about the stability and robust return that the farmland can provide, that provided for a lot of the safe and stability for many investors and even institutional investors. Even though Iowa is restricting corporate land ownership, so the effects is not nearly as felt as other states like Illinois, we still see this is driving the strong demand from both investors and farmers for farmland, not only from the production standpoint, but also from an investment and wealth holding standpoint. Right? So, and on the right, we have done analysis which shows that if you bought, say, if you have money in the same amount of money, how much you would earn when you invest in farmland compared to you put it in the stock market, except that you buy land during the high inflation years pre the 1980 farm crisis. Typically, over the last 50 years, you'll have a high chance that you can potentially beat the stock market. Right? So what are some of the negative factors that people noting that are driving down land market? One thing that people notice is lower commodity prices, especially early on when we are asking these questions without necessarily seeing the dramatic price rallies or looking at the season average prices. And many people notice the weather and derecho impacts, especially in central and east central Iowa. The two new factors that is never mentioned before over the past few years is the COVID-19 pandemic-related uncertainty, and I think this also is reflected in the general economy uncertainty that's related to this as well. and about 7% of people also noticed the political uncertainty related to 2020 presidential and Senate races. Right? So when we are looking at the land values by district and quality, only Southwest show a decline. All the other districts show an increase. So when you are thinking about the growth, it's about 1.7% growth statewide. The range is modest 0.2% growth in North Central, ranging from to about 3.9% growth in West Central. The quality differentiation is probably more important, that we are seeing 0.1% decline in high quality land, as I mentioned, a $10 decline, but a 6.7% growth for low quality. Overall, I think one, the low quality land is related to a strong demand for recreational grounds, where it becomes even more appealing when the social distancing requirements makes outdoor activities more desirable. Another thing you need to keep in mind is that the lower quality land, it doesn't take a whole lot of dollar amounts to change to yield a much higher percentage increase. Right? So $100 increase in the lower quality land, because the lower land values tends to push up this percentage much higher. We have done research with my colleague Sergio Lenz that when you are looking at the historical land market responses, in general, the higher quality land responses are more salient signals. So these trends are more reliable compared to lower quality, because lower quality land has more differences. There could be lower quality cropland, there could be timberland, there could be pasture land, they could also be receiving or not necessarily receiving CRP payments. So there are a whole lot of other factors driving lower quality land. So although I think these are really important differentiations, I don't want you to read too much into it. Right? So overall, I think the land market shows there are stabilization, there are modest growth. This shows surprising resilience despite the mounting uncertainty, and this also reflects, this also shows that how changes in economic fundamentals like the Federal Reserve interest rates and strong injection of the government income could potentially lead into land market increases. Right? So when we dive down to look at, for example, how different districts shows, here's a formula that I talked about before, that the land markets, land values equals net income divided by interest rates. Interest rate tends to be more universal from district to another, from a state to another, but the income tends to be more localized. And when you are thinking about, for example, North Central, we have fairly high hog and hog production, and we have, when we are thinking about, for example, some of the highest crop production in the West Central and Central districts has much higher corn and soybean acres as well, which also got affected significantly in the derecho. These showing you the satellite image. The white portion shows you some of the crop damage, right? So when you are thinking about these growths, the East Central, for example, that didn't show significant growth compared to other districts, and the higher quality show a 2.1% decline. I think that in part is related to the derecho impacts as well. And the North Central Iowa, for example, is not necessarily showing an increase in lower quality land. It's because that when you are thinking about where the recreational grounds are distributed, they are not necessarily in North Central, they are in northeast and southern part of Iowa. So those tend to support the lower quality growth in south central northeast, for example, right? So there are some of the regional specific factors that's driving, and when you are looking at how our results compare with other states, other surveys, this shows you a comparison with Realtor Land Institute survey that was released this September. Overall, they're reporting a 0.1% growth rather than 1.7% growth. So this, I think, this strengthening and more positive estimates is in part reflecting what the ag professionals are seeing in the commodity markets, exports, and strengthening of the sales, right? So these timing does matter, but overall, I think both surveys show a stabilizing and modestly growth market, right? So which is also consistent with the Federal Reserve Bank of Chicago estimates shows 1% growth from October last year to October this year for Iowa land values and 2% growth for Illinois, which is comparable. And the Indiana number is much higher, but if you look at the Purdue University estimates, for example, that a lot of those growths are happening actually later of last year. So a lot of those growths are coming from late 2019. The January to June 2019 land market changes in Indiana is about 1% as well. Right? So, and the USDA land value survey, June area survey, reported a slightly more negative results, so 1.7% growth. This survey is it's a little different because this is a producer survey, so asking the producer to estimate for a parcel that they farm, how do you estimate your market value would be? And note this is as of June 2019, in the depths of the COVID-19 pandemic, without necessarily seeing any signs of surging commodity prices. So this is also understandable. We are seeing more positive results than this survey, right? So looking across states, and this shows you several of the different sources. The first column shows you the USDA 2020 June area survey that I showed you. This is essentially the same number on this map. Iowa declining 1.7%, Illinois growing less than 2%, Indiana at 3%, and then followed by several of the different land grant university estimates. You're seeing there the market tends to range about 1 to 3% for the I states, which is most comparable to Iowa. And so overall, you are seeing the stabilization and some consistency across different sources, which point to a stabilizing and market probably in modest growth thanks to those much lower interest rates and as well as record level government payments. Right? So when we are looking at where the land markets shows how the spatially distributed the land values are, the patterns still are the same. The highest county, the county that reports the highest land value is still Scott County. So followed by several counties in like O'Brien and Northwest districts. I showed this map before. If you stare at this map and look at the red color and orange color, and this tends to coincide with the beige yellow color here, which tends to have higher CSR2. So in the Des Moines Lobe area with higher soil quality, you tend to see higher land values. Again, the formula I mentioned earlier, higher crop yields, higher land soil quality, meaning that for the same production cost, you can get higher crop yields, higher income, higher land values. Those are the insights of the David Ricardo, prominent land economist 200 years ago. Right? So that still apply to when we are looking at the land markets. So when you are thinking about where the percentage change are looking at, the yellow color shows a decrease. So there are about 15, 20 counties posting modest declines, not dramatic. So there, the highest would be the Henry County, 3.4% decline, and the highest growth would be Decatur County with 7.4% growth. So which coincide with some of the findings. We're finding that the South Central and Southern Iowa, for example, are showing a strong demand and strong growth, especially this supported by lower quality land growth in both Northeast and in South Central Iowa. Right. So overall, we are seeing a modest growth for most counties, and there are more than 75 out of the 99 counties are posting increase compared to other years, and it tends to be spatially clustered in similar colors as well. Right? When we are thinking about who are buying Iowa's farmland, it's still the similar pattern compared to previous years. It's dominated by existing farmers, especially existing local farmers. So almost about 70% of the the land that is bought by 72% of the land bought by existing farmers. Of those, 69% are bought by existing local farmers. Investors are showing a very modest growth, but it's standing at about 20% in terms of the percent bought by investors, and new farmers still constitute as a fairly low share in the land market. Who are selling the land? The highest amount is still estate sales, more than half, so 51%. There are important regional differentiations where the West Iowa, North Central, and West Central, where the regions with more farmers and potentially more retiring farmers are having more estate sales. You could see how the uncertainty and resulting from the pandemic potentially give more incentive to think about how we transition. And again, on Thursday, I will talk about the farm transfer survey to give you more understanding on what is the trends and situation related to farm succession and business transfer in Iowa. So 23% of the, another 23% by seller is coming from retired farmers, and 16% overall is coming from active farmers. And the South Central tends to have more investor demand and also investor-owned land as well, and often in recreational related acres. So they represent 20% of the South Central sellers, and while the whole across the district, across the state is only 9%. Right. So when we are looking at the crop and land price forecast, you can see how the commodity price rallies have put more optimism among our respondents. For example, at the bottom, if you start from the bottom, that shows you the same prediction in 2017 and 2019, which forecast about $4 corn 5 years later. Right. So the forecast for near horizon 1 year later corn prices, it's only 3.30 cents, 3.30 and 3.50, but this year is close to 4. This is clearly driven by the recent rally in the commodity markets, and you also see that in the soybean prices, as well as that a lot of people are hoping for about the $10 soybeans and $10.60 5 years later, right? So looking ahead for the land value predictions 1 year and 5 years from now, overall, that the no change represents the largest category. So it's most people, the highest people, they're reporting no change. There are when you are looking at the blue bar contrasting with the orange bar representing the 5-year horizon forecast, how land values would be 5 years from now. You see they are more shifted towards the right, meaning that they are forecasting more growth in these markets, right? So overall, when you are seeing for the next year growth, it tends to be people are forecasting a more stable market and maybe some modest growth, okay? And this is somewhat consistent with the Ag Economy Barometer producer expectation from Purdue University. On the left, it shows you the farmland prices of 12 months ahead, so a year later by 400 producers nationwide. And if you see a green bar, that's a percent of people who are expecting higher land values in their area, right? 26% at this point are thinking about increase in land values, right? So contrasting with about 10% reporting declines. So over 2/3 of people in their survey also thinking about their land markets 12 months from now would be stable, right? So there's no change. So when you're looking at, for example, on the right is the farmland prices expectations 5 years from now. It's much higher percent for the growth. So the green line represents percent of respondents who are expecting higher land prices, and that stands increase from 25% to 54%. So people are overall more optimistic about the longer and medium-term run land markets. And my predecessor, Dr. Mike Duffy, reminded me that farmers are eternally optimistic. So this is reflected in these charts as well, right? So I want to end with some policy discussions, given that we have seen the change of the government, that the Ag Economy Barometer has an interesting question added this month, talking about how do you expect the farmers' expectations regarding changes in policies affecting U.S. agriculture over the next 5 years. So the black bar represents the expectations in October, and the yellowish bar is post-election expectations. So you can think this is before you know who will win the election, considering that 80% of the farmers are going to vote for President Trump. And on the right, the yellow color would be what the expectation would be when they know that there will be a Biden administration, right? So you can see there are more worries about more restrictive environmental regulations, potential higher estate taxes, higher income taxes, and also some worries about the weakening support for ethanol industries and farm income safety net, right? So one of the good things for Iowa farmers is that the next USDA secretary is a familiar guy, right? So the former USDA secretary and former Iowa governor, Tom Vilsack, and I think that a lot of the policies the Iowa farmers and Midwest farmers will definitely has a significant role in voicing these concerns and shaping the policies. The last slide I have is related to trade policies. So because that exports is such a significant influencer for farm income and land values and commodity prices, I want to make some conjectures on what we can potentially expect for future President Biden. The first thing I want to do is probably lower your expectations on tariff rollbacks and cuts. that when you are thinking about the new administration's priorities, these negotiating new trade agreements and potentially revamping these trade deals will not likely be immediate policy priority, will be especially when the new administration has COVID-19 responses and climate change and potentially national security, international security issues like Iran nuclear deal to worry about. But we'll see probably more polite discussions with China. There will be more reestablishment of normal communication channels that hasn't been happening for years. And we'll likely see a multilateral approach, which has pros and cons, because that if you really honor to bring all allies on board, you can see that China is also becoming more aggressive against, for example, smaller and less politically powerful countries like Australia and other countries, which potentially can not necessarily, you may not have as universal in voices as probably President Biden would hope. China, one of the interesting to watch is that likely China will maintain, the phase one deal will likely maintain at least for, because at least for the first year that the Biden administration likely won't have time to deal with the renegotiations. And China, and along with Asian countries and Southeastern Asian countries, creating a new trade pact called RCEP, Regional Cooperation Economic Partnership, will likely provide more incentive and discussions on the merits and possibilities of U.S. rejoining TPP. So that overall, when you are thinking about agricultural exports, more free trade agreements tends to bode well for U.S. agricultural exports. With that, I will close and remind you that you can find all these information. I trust that these are already posted here online, including all the overview slides, and recording will be up online tomorrow. You can find the maps and figures and download all the information since 1950 through this ISU card website. And feel free to get in touch with me if you have any questions. Thank you very much for your attention. Have a happy and peaceful holiday season. So, do we have any questions? Gene?
Well, I think the obvious one, you answered it mostly, but the predictions for this next year, one would be, I guess, the farm program payments. Do you see those disappearing and having an impact on land prices?
So the question is about whether the farm income, the government payments potentially could be disappearing, whether that could impact the land prices. So I think there are possibilities that the farm, we won't necessarily see such a high level of the ad hoc federal aid payments, depending on, especially now we have the prospects of the vaccine. And the higher commodity prices will also make some of the commodity program like PLC not necessarily trigger the payment threshold, right? So when you are looking at the government payments charts, for example, we are unlikely to see a continuation of the trade aid payments, and the COVID aid likely will shrink as well. However, that these payments also take multiple years to be capitalizing the markets, so we'll still enjoy some residual impacts through this surge in the government payments, like at least in the next year's farmland market. However, that I'm also hopeful that once if we take advantage of this commodity price rally, and thinking about how and also whether if we have less disruption in the exports market, then potentially we can see some gradual improvements in the fundamentals. And in general, when you are thinking about the land downturns, it takes about the commodity price declines. We have been in much lower commodity prices compared to 2013. It takes about 6-7 years for us to go back to break even and modest profits. And I think we are roughly at those points. So we are unlikely to see a rapid return into the golden era as in the early 2000s we are seeing double digits growth in commodity prices and farm income and land values as a result. But I think we'll still see a robust payments and farm income as well as income in the foreseeable future.
I guess the other question would be the fact that you saw the lower end farmland, investment land, and recreational land kind of leading the way on this. And you mentioned that one reason would be the fear of other investments, essentially, of the competition for investment dollars. Do you see that continuing, or do you think that was a temporary COVID kind of thing?
Yep. So the question is about whether I see that the interest in farmland rising because the lack of other viable alternatives or the lousy returns on other investments. So whether I see that potentially increasing. I do see that potentially increasing because over the past few years that there's a reckoning in the investment community that the farmland can be part of the investment portfolio, that the doctrine in general think about that you want to have 10% of your investment in real estate, that now I think increasingly I see more and more people thinking about that out of those 10%, 1% could be farmland, right? So they're not necessarily just looking at cropland, they're not necessarily just looking at the U.S. farmland, but thinking about land as one of the asset class that give you a robust return, maybe not super high, but is at least you don't necessarily expect dramatic declines, has appealings for those long-term investment. So again, these I think are interesting factors, and however that in the Iowa land market, still your neighbors and your local farmers driving the market rather than the investors. I could see the investor become even more interested, for example, if we have new policies thinking about how we can give subsidies related to carbon sequestration in land, right? So there could be more investment, not only interest in ag interest, but also potentially environmental investment funds interest in the ag space if we have those policy changes. But those, I think, are still not necessarily dramatically impacting the current and near future land market yet. All right, great. Thank you very much for your attention. And again, so if you this is a portal, card.istate.edu/farmland. You should be able to find your county, district, and state level land value information. If you have any questions, feel free to get in touch with me. Thank you very much.